Welcome to Decode Station. I'm Sarah. Imagine logging into your bank account on just a random Tuesday, and the $10,000 you carefully saved for a down payment is just entirely gone.
That is a genuinely terrifying scenario to picture,
Oh,
especially when you realize there's no error message and no customer support line answering your calls.
it is absolute panic because you were just staring at an empty screen where your financial security used to be. Over a single weekend in November 2022, millions of people woke up to exactly that nightmare as a $32 billion cryptocurrency empire completely vanished into thin air.
We're diving into the spectacular rise and the catastrophic, really chaotic collapse of a cryptocurrency exchange known as FTX.
The sheer scale of this disaster is hard to overstate. So to truly comprehend the wreckage we eventually see, I think we have to rewind to the origin point in 2019.
That origin point gives us the necessary context, because this platform was founded by Sam Bankman-Fried, whom everyone in the industry referred to simply as SBF, along with a programmer named Gary Wang.
What they launched was not just a basic digital storefront for buying Bitcoin, which is, what a lot of people think of when they hear the term crypto exchange.
They deliberately designed an advanced platform that allowed users to trade both standard cryptocurrencies and highly complex crypto-based derivatives, such as futures and options.
I want to stop right there and unpack that for a moment because the term derivatives can sound incredibly intimidating if you only ever buy regular stocks or standard digital coins.
It absolutely can be intimidating, so breaking it down is essential for understanding the risk involved.
If I am a casual user, a derivative means I am not actually buying a Bitcoin to hold in a digital wallet, but I am essentially entering into a complex contract to bet on what the price of that Bitcoin will be next week or next month.
Offering that kind of high-level, high-stakes trading to the general public was a massive game changer for the industry at the time.
The platform essentially provided institutional-grade Wall Street-level tools to everyday people, making these incredibly complex financial maneuvers feel seamless and accessible.
For the millions of users listening around the globe who eventually flocked to FTX, that slick technological veneer projected an aura of absolute mathematical precision and unwavering stability.
That perceived stability was completely manufactured, though, wasn't it?
It was a carefully calibrated illusion, meticulously cultivated by Sam Bankman-Fried himself, because he recognized early on that the cryptocurrency industry was widely viewed by the traditional financial world as a chaotic, unregulated Wild West.
To dominate the market, he constructed a public reputation as the rare, responsible adult in the room, which is a fascinating psychological play.
He would deliberately wear casual clothes shorts and oversized T-shirts, while simultaneously making highly publicized appearances to speak before lawmakers in Washington.
He was constantly vocalizing his support for government regulation and responsible innovation, which creates a stark, incredibly reassuring contrast to the anti-establishment ethos that defined much of the early crypto industry.
That carefully crafted reputation of responsibility is exactly what fueled the explosive, completely unquestioned growth of the platform between 2020 and 2022.
When you are an investor or just a casual observer of financial markets, seeing a young CEO openly inviting government scrutiny signals to your brain that this entity has absolutely nothing to hide.
That cognitive shortcut allowed FTX to experience a meteoric expansion that seemed to defy the laws of financial gravity, pulling in massive institutional players alongside everyday retail investors who had never touched digital currency before.
The overarching strategy to capture that widespread mainstream demographic relied on an aggressive, omnipresent marketing campaign designed to manufacture absolute public trust.
The company deployed hundreds of millions of dollars to saturate the broader cultural landscape, including purchasing the naming rights to the Miami Heat sports arena.
Pinning their name to a sports arena brilliantly cemented their digital brand into physical, real-world infrastructure, making them feel permanent.
Furthermore, they secured major, highly publicized endorsement deals with universally trusted celebrities and athletes, including Tom Brady, Stephen Curry, and Larry David.
We have to look at these not just as advertisements, but as psychological anchors for the average consumer.
When millions of people see culturally revered, highly successful figures aligning their personal brands with a financial platform, it fundamentally alters the public's risk assessment.
Those marketing efforts built an absolute fortress of brand recognition because you see an ad during the Super Bowl and you inherently assume that a massive team of lawyers and accountants must have vetted this company.
But while the public was entirely focused on the celebrity endorsements in the sports arenas, a massive shadow was operating just out of sight behind the platform's code.
That shadow was Alameda Research, the cryptocurrency trading firm founded by SBF prior to the creation of FTX, which brings us to the core of the deception.
The narrative sold to the public and to regulators was that FTX and Alameda were two completely distinct, legally separate organizations.
However, the reality of their relationship was dangerously intertwined, with Alameda playing a major, continuous role in providing heavy liquidity to the FTX exchange.
We should define what providing liquidity actually means in this context, because it sounds like a positive service on the surface.
Providing liquidity is a standard practice in financial markets to ensure that buyers and sellers can always execute their trades smoothly without massive price jumps.
Think of it like a massive car dealership, where the dealer needs to hold a large inventory of cars so that whenever a customer walks in, they can immediately buy, and whenever someone wants to sell a used car, the dealer has the cash to buy it.
Alameda acted as that primary dealer for the FTX exchange, constantly buying and selling to keep the market moving. But the critical, fatal issue here was the complete lack of boundaries between the two entities.
Later investigations revealed the devastating truth that Alameda Research had access to special, hidden privileges built directly into the FTX platform's underlying code.
Let us break down exactly what those hidden privileges entailed, because this is where the story shifts from aggressive business tactics to outright financial horror.
To put the danger of that structure into perspective for you, imagine walking into a high-end, highly regulated casino where you expect the house to facilitate the games and collect a small fee.
That is exactly what FTX claimed to be doing, but imagine discovering that the house is also the biggest, most aggressive gambler at the poker table, taking wild, highly leveraged bets against the actual customers.
That analogy captures the dynamic perfectly, but the reality of the software code made it infinitely worse than just an unfair advantage.
The hidden privileges meant that whenever this massive player, Alameda, started losing those wild bets in the broader market, they had a secret mechanism to reach directly into the casino vault.
They were granted the ability to secretly borrow virtually unlimited funds to cover their losses, making the separation between the exchange holding customer assets and the trading firm placing highly speculative bets completely illusory.
And that secret ability to borrow unlimited funds leads directly to the fatal flaw in the entire foundation of this empire, which was the underlying balance sheet.
The structural integrity of that balance sheet was finally dragged into the light in November 2022, and it is fascinating how quickly the dominoes fell once the curtain was pulled back.
The catalyst for the entire collapse was a devastating investigative report published by the cryptocurrency news outlet CoinDesk, who somehow got their hands on Alameda Research's private financial documents.
The report exposed severe, immediately alarming concerns about the firm's true financial position, revealing a startling composition of assets that made absolutely no mathematical sense for a trading firm of that size.
A massive portion of the billions of dollars Alameda claimed on its balance sheet wasn't held in traditional fiat currency like US dollars, nor was it in established, highly liquid cryptocurrencies like Bitcoin.
Instead, the wealth was overwhelmingly concentrated in a digital token called FTT, and the mechanical nature of this token is the central puzzle piece to understanding this massive fraud.
FTT was a token created entirely out of thin air by FTX itself, functioning effectively as company script or digital loyalty points.
FTX would offer discounts on trading fees to users who held FTT tokens, giving the token a perceived utility. But the dark brilliance of the scheme was the artificial valuation.
Because FTX controlled the vast majority of the FTT supply, they could restrict how many tokens were actively trading on the open market, manipulating the price dynamics.
By buying up small amounts of the token themselves, they could drive the trading price incredibly high, take those inflated tokens, hand them to Alameda Research, and allow Alameda to use those billions of dollars in made-up value as collateral to borrow actual real-world assets.
Explaining that flywheel effect is so crucial because it is the ultimate house of cards where they essentially printed their own money, used their own platform to pump up the price, and then used that inflated price to secure real loans.
Because the value of FTT relied entirely on the market's ongoing confidence in FTX, investors reading that CoinDesk report suddenly realized they were looking at a devastating, inescapable feedback loop.
Industry observers and massive institutional investors instantly began questioning if these two supposedly independent companies were far too entangled to survive even a minor market shock.
That market shock arrived almost immediately, transforming those quiet analytical concerns into absolute visceral panic triggered by the CEO of a rival, much larger cryptocurrency exchange called Binance.
Following the shocking revelations in the CoinDesk report, the CEO of Binance publicly announced on social media his intention to sell off all of Binance's massive accumulated holdings of FTT tokens.
In the delicate, highly reactive ecosystem of financial markets, a major player announcing the total liquidation of a specific asset signals profound structural weakness.
This announcement essentially yelled fire in a crowded theater, triggering pure panic among investors and instantaneously destroying the fragile psychological confidence that gave the FTT token its high value.
You cannot understate the panic that single social media post caused, because everyone collectively realized that if Binance sold, the price of FTT would plummet to zero, wiping out Alameda's collateral.
The immediate result was a massive, frantic wave of customer withdrawals from the FTX platform as everyone wanted their money out before the doors closed.
And the profound irony here is something you have to fully appreciate when looking at the broader narrative of digital finance.
We are talking about an industry entirely built on the promise of advanced financial technology, secure blockchain verification, and decentralized futures.
Yet, despite all the lofty talk of revolutionizing modern finance with complex algorithms, FTX was ultimately brought down by a classic old-school bank run.
They were fundamentally unable to process those customer withdrawals because they simply lacked the actual liquid assets to match the deposits.
That lack of liquid assets was the immediate mechanical failure that broke the platform, but it masked a much darker, far more criminal reality operating behind the scenes.
Within a matter of days, this liquidity crunch escalated into a catastrophic, full-scale financial crisis, and FTX was forced to halt customer withdrawals entirely.
They effectively trapped billions of dollars of user funds on the platform with no explanation, leading Sam Bankman-Fried to attempt to secure emergency funding from anyone who would take his call in a desperate, frantic bid for survival.
There was a brief, highly publicized moment where Binance tentatively agreed to a bailout acquisition, essentially offering to buy FTX to save the users, but that lifeline completely fell apart the very moment Binance executives performed standard due diligence.
Once they looked beneath the hood and saw the horrifying reality of FTX's internal accounting, they immediately walked away from the deal, stating the issues were beyond their ability to help.
Left with absolutely no other options, and with the regulatory authorities closing in rapidly, the empire officially crumbled, and on November 11, 2022, FTX formally filed for bankruptcy.
Sam Bankman-Fried was forced to step down as CEO, and a restructuring specialist named John J. Ray III was brought in to take over the monumental task of unwinding the wreckage.
For context, John J. Ray III is the exact man who oversaw the liquidation of Enron, meaning he is someone who has seen the absolute worst of corporate malfeasance.
Yet he publicly stated he had never seen such a complete failure of corporate controls in his entire career, which tells you everything you need to know about the state of FTX's books.
The wreckage that the new CEO uncovered went far beyond mere incompetence, poor risk management, or a volatile market downturn.
The ongoing investigations quickly revealed the core, undeniable offense that turned a standard business failure into a historic criminal scandal.
Billions of dollars in customer funds had been secretly, systemically transferred from the FTX exchange directly to the trading firm Alameda Research.
We're talking about the hard-earned funds that everyday users and massive institutional traders had deposited onto the exchange specifically for safekeeping and standard trading.
Instead of holding those funds securely, the leadership at FTX siphoned those deposits off and allowed Alameda to use them for incredibly risky trading activities, massive venture capital investments, and lavish multi-million-dollar corporate loans to themselves.
To truly grasp the severity of this violation, consider how you interact with the traditional, regulated financial institution where you expect a basic standard of custodial care.
When you place your grandmother's antique heirlooms in a safe deposit box at your local bank, you pay a fee for the absolute security of knowing they will sit exactly where you left them.
What the executives at FTX did is the equivalent of the bank manager waiting until you leave the building, unlocking your secure safe deposit box, taking your family heirlooms, and driving across town to use them as collateral to gamble on highly volatile tech stocks.
You only discover the massive theft when you return to the vault months later, open your box, and find an IOU scribbled on a napkin, representing a fundamental breach of the core contract between a custodian and a client.
You are illustrating the exact reason why this collapse was so devastating, because the unauthorized deployment of those assets completely violates the most fundamental expectation in global finance:
When a customer deposits money onto an exchange, the implicit and legally explicit agreement is that those funds remain entirely segregated and available for the customer to withdraw at any given moment.
By actively using customer deposits to collateralize Alameda's highly speculative trading positions, the leadership at FTX completely obliterated the necessary boundary between custodial assets and proprietary trading capital.
This systematic, intentional misuse of customer funds became the central defining issue in the ensuing legal trials and the massive regulatory fallout that continues to this day.
The global shockwaves generated by that profound betrayal of trust absolutely cannot be overstated, as the collapse of FTX sent immediate, devastating contagion throughout the entire cryptocurrency industry.
Other lending platforms and trading desks that had exposure to FTX suddenly found themselves insolvent, creating a domino effect of bankruptcies that ravaged the sector.
As the legal process commenced, billions of dollars in customer funds were instantly frozen, plunging countless individuals and businesses into an agonizing financial limbo.
The human toll was massive and deeply tragic, resulting in devastating financial losses for everyday investors who had placed their life savings onto the platform, believing the carefully constructed facade of regulatory compliance, safety, and celebrity endorsement.
The psychological damage to the broader market is arguably just as significant as the direct financial damage, completely altering how the public views digital assets.
When a massively popular platform bearing the endorsements of global sporting icons and real estate arenas simply evaporates over a single weekend, the average person is forced to realize that the traditional markers of corporate legitimacy might just be incredibly expensive illusions.
This disaster forced the entire global financial ecosystem to abruptly reckon with the actual underlying mechanics of the digital businesses they were trusting with their capital, causing the industry to lose the benefit of the doubt overnight.
Synthesizing the macro-level takeaways from this spectacular collapse reveals an industry that has been entirely transformed by the trauma, triggering urgent, unprecedented demands for strict, verifiable regulatory frameworks across global jurisdictions.
Investors and lawmakers alike finally recognized that the cryptocurrency industry could no longer be trusted to self-regulate based on the promises of charismatic founders.
We are now witnessing necessary industry-wide demands for verifiable transparency to ensure this specific type of fraud cannot happen again.
Exchanges are now heavily pressured to provide cryptographic proof of reserves, which is a mathematical way of ensuring that the exchange actually holds the digital assets they claim to hold on their balance sheet.
Furthermore, there is a renewed, rigorous focus on serious risk management protocols, specifically demanding ironclad, legally auditable separation between a customer's personal deposits and the corporation's trading funds.
The era of offering blind trust to eccentric geniuses in T-shirts has effectively been replaced by a rigid demand for mathematical proof and regulatory certainty.
That harsh transition from blind trust to required certainty leaves you with a lingering, deeply unsettling question to consider long after this deep dive ends. If billions of dollars and millions of supposedly sophisticated users can be entirely captured by a brilliantly executed marketing illusion, all backed by a made-up token printed out of thin air, how much of our broader, modern digital economy is entirely reliant on the fragile perception of trust rather than actual, unshakable financial mathematics? Stay curious, stay skeptical. See you in the next episode.